And we are live, I think. Um, can somebody just type a message in the comments if you can see and hear me? I just want to see if it's coming through. Um, okay, I can't seem to see any comments. Okay, I can see it's definitely streaming. Okay, perfect. There I can see the comments coming through. Awesome stuff. Hi. So welcome to my first live stream. I'm actually using a new software. And yeah, I'm still figuring the whole thing out, so just be patient. So, my name is Megan Gajewski. I am taking you for your deferred tax module, and I thought it would just be a great idea if we can just have these discussions, deferred tax discussions. Morning to everybody in the chat. I can see your messages coming through, so that's awesome. And I'm also keeping my eye on the chat for any questions that come up. Okay, so the purpose of these talks is I feel like because we're not in a face-to-face setting, it's quite difficult to kind of gauge where students are at, and I really want to connect with you all. So what I'm going to do is I'm going to schedule these talks weekly, and we can just catch up with where we are in the course. Well, for deferred tax specifically, I'm thinking of making this thing a bit broader, where I have like sessions on a particular date, where it's almost like a consultation, but we can engage online. But yeah, I'm still working all the details out around that. But anyway, let's get into deferred tax. So this week you started your deferred tax, and deferred tax, I think you may have heard the war stories. It's not exactly the easiest thing, but the good news is this: it's something that once you get it, you get it, and it's gonna test your it's really gonna test you in terms of whether you're actually paying attention and understanding. And my advice for how to approach this module is that you need to make sure that you're keeping up to date with the TUTs, okay? Because practice, practice, practice. If there's any module in accounting where I can say you need to practice, it's this one. Because deferred tax, from the time that you learn deferred tax until you are done with accounting in your at your retirement, okay, you're finished now with accounting, you want nothing to do with it anymore, you will be doing deferred tax, because every single asset or liability that's on the statement of financial position could have some deferred tax implication. And so it's really important that you understand how to account for the income tax consequences of the assets and liabilities that we've recognized. So this week, in terms of the tutorials, the unseen TUT that you're going to do next week in class, well, in your TUTs with the tutor, it's a very great TUT. I do encourage you to work through it on your own. And what that TUT is testing specifically is whether you understand what is a tax base, what is a temporary difference, and whether that temporary difference is effectively taxable or deductible. So before we get into the scene TUT, which is illustrative example 1, I know a lot of people were asking where's the solution, but if you read illustrative example 1, it's actually the question and the solution is right there in the standard. Okay, so I've got it over here. Sorry for the children having a meltdown in the background, but that's just how it is when you work from home. Okay, hopefully that stops soon. So, the example is there, but there's something confusing about the example that I don't like, because it does something weird in that it doesn't give you a profit that the entity has made for the period, and so it becomes difficult to understand the numbers because you're not seeing it in line with a profit figure that typically would exist. So I thought I'm going to do a little amendment to the example, I'm just going to do it in Excel, and then we're going to go through it together and discuss it. If at any point you don't understand anything, please put a comment, and I will I'll try and address it as it comes up. Okay, so in terms of the example, illustrative example 1 deals with depreciable assets. And really, what this example is trying to do is it's trying to illustrate what would happen over a number of years. So, over the useful life of the asset, what would happen to the in terms of the depreciation, the deductions we get on the asset, and so forth. And it's trying to map out the numbers year on year on year. And why I like this example is because conceptually it can help you grasp what is actually happening in the future. Because the thing with deferred tax, we always talk about we talk about tax now, and we talk about tax in the future, and we talk about whether it's higher or lower. And so what I like about this example is that it actually shows you what's happening in the future, because you're visualizing 5 years. Okay, so now I'm going to share my screen. I've got an Excel. I've done the example in Excel with the amendments that I've made, and I'm going to post it to Vula after this presentation is done so that you can also play around with it. Okay, but I thought it's just useful to discuss it first. So I'm going to share my screen. Just let me know if you can see an Excel spreadsheet. Can somebody just tell me, yes, we can see it? Just waiting for a comment. Okay, perfect. Thank you, Earthly Serenity. Okay, so in this example, okay, I've got to go to my screen now. But wait, I want to be able to see. Okay, so I'm going to be on my screen, and then I'm going to talk through stuff because I can't see my spreadsheet as well as the comments in the same at the same time. So I'm going to talk through a part, and then I'm going to go to the comments. Okay, so what we've got is we've got a machine, sorry, an item of equipment. Okay, it's 10,000 units, and then it is depreciated 5 years straight line, so that's depreciation of 2,000 per annum. We're getting wear and tear of 25% per annum, so that's 2,500, and the tax rate is 40%. Now, what I've done here is, as in the example, I've mapped out the different years. So where I've got 1, 2, 3, 4, and 5, that would represent the end of that year. Okay, so obviously at time 0, the carrying amount of the asset would be 10,000, but at time 1, the carrying amount would be 10,000 minus 2,000, which would be 8,000. Okay, and so forth. So the one difference, the one thing I've added in here is this line. Okay. Let me just do that in yellow. Okay. So I've just said assume that profit before tax and depreciation is 5,000. Okay, because if you assume that there is a profit, then the numbers we can more clearly be able to see the numbers, the impact of the numbers on the statement, on the income statement and the statement of financial position. Okay, so if we assume that the profit before taking into account tax and depreciation is 5,000, right? Then for every year we have to go and deduct the depreciation. Okay, so that's the 2,000 over there. So that's exactly the same as the example. And so this would also be different from the illustrative example because this is an assumption that I've made. Okay, so then that means that my profit before tax now is 3,000. And that's our starting point. That's our profit before tax. But now, if we want to work towards calculating our current tax, what must we do? We have to firstly add back the depreciation. Oops, what is going sorry, I need to add something. Oh, let me put it in here. Sorry, so we start with this. There we go. Okay, and then we must add back depreciation. Okay, and then F2, there we go, equals that. Okay, so sorry, my taxable income is that plus that minus that. Okay, okay, we are back in business. So, what I'm trying to do over here, okay, is calculate what is my current tax that must be paid to SARS. Okay, so the way we calculate our current tax is we start with our profit before tax and we're going to adjust it for the differences between accounting and tax. So we're going to add back the depreciation, which is the 2,000 per annum up there. We're going to take off the wear and tear. Now, because the wear and tear is 25% per annum, you can see that we're actually getting wear and tear over 4 years, and in the 5th year, there's nothing. So year on year, we can see that there's a difference between my accounting profit, so to say, and my profit from a tax perspective. So in deferred tax, we use the term tax profit, and when we say tax profit, you must understand that to mean taxable income. Okay, so I'm going to use those terms interchangeably, and just know that when I'm speaking about tax profit, I mean taxable income. So we can see that in any given year, there is actually a difference between what my profit is from an accounting perspective versus what my profit is from a tax perspective, and that's because of the differences in how this asset is being depreciated from an accounting perspective versus from a tax perspective. Okay, and so then if we calculate our taxable income, okay, over here, okay, or our tax profit as we say, okay, that taxable income we must then we must apply the tax rate, and so that's 40%, and so it gives us current tax of that amount in every given year. Okay, so at this point, I'm just going to go back to my main screen so I can see if there are any comments. So if you have any questions, wait, why is this not coming up now? Okay, if there are any questions, just let me know. You can just type your question. Okay, I don't see any questions yet. Okay, so I'm going to go back. Cool. Now, in the next part of the example, so they also start off calculating their current tax, but then we move on to the statement of financial position. Now, when we are working with deferred tax, because deferred tax is going to be levied or it's going to be calculated on the assets and liabilities on the statement of financial position, we always look at deferred tax from the perspective of the statement of financial position. Now, you can look at it from what we call an income statement approach, but an income statement approach, I find it's a lot more difficult because sometimes there are things that you can miss. There are transactions relating to the asset that you can miss, and then you can end up forgetting to account for the tax on those transactions. However, if you're looking at the statement of financial position, okay, what's nice about that is that you're just taking the carrying amounts of the assets and the liabilities at a particular date, and you're asking yourself, what's the tax base? So if I have now, okay, my carrying amounts for this equipment, okay, we know at the end of year 1 it's 8,000 because it's been depreciated by 2,000 and so forth. At the end of year 5, of course, this asset is fully depreciated, so at the end of year 5 we would expect to de-recognize the asset because we have fully consumed the economic benefits. Now, this part over here, the tax base, this is where people get so confused. A tax base is really, really important to understand, because if you don't understand what a tax base is, you don't get deferred tax. Now, from a simplistic term, okay, what a tax base is, it is, if you can imagine, SARS is drawing up your statement of financial position, okay, what do they think your asset is worth? Okay, so from SARS's perspective, okay, if we look at year one, in year one, SARS has given us a deduction over there of the 2,500, right? What is that wear and tear? It represents what SARS thinks the depreciation is, right? Now, our depreciation is actually different because we disagree with SARS on this, but from their perspective, they're saying this asset must be depreciated at 2,500 per annum. So at the end of the year, if SARS is looking at our statement of financial position, what do they think the asset is worth? They think the asset is worth 7,500, right? Because it was the original 10,000 that we purchased it for, less the allowance that they gave us. So they think it's worth 7,500. Sorry. So that is the tax base from looking at it from the perspective of SARS. However, if we go to our standard, okay, so I've got the standard over here, and I'm looking at the definition of my tax base. So paragraph 7, and I hope you've read paragraph 7 and 8. Okay, I gave you 3 things to read this week: paragraph 7, paragraph 8, and paragraph 15. So paragraph 7 deals with the tax base of an asset, okay, and it says that basically, I'm just going to put this over here. If you looking at the tax base for an asset, okay, there's 2 things that you need to consider. Firstly, you need to think about the FEBs. Okay, so are the FEBs, the future economic benefits, taxable? Okay, or are the future economic benefits not taxable? Okay, so if the future economic benefits, right, are taxable, then your tax base is any deductions you can claim against that taxable income in the future. Okay, so what does that mean? Think about your asset, right? If when you recover your asset in the future, you will be taxed, right? Your tax base becomes any deductions that you can use against that in the future. So in the case of our equipment, right, how are we going to recover our equipment? Well, our equipment is going to be utilized probably in the production process. So we're utilizing it in the production process, which means that we are going to produce inventory, which then will be sold, and those sales of inventory are going to be taxed. Okay, it's going to be taxed in the future. So as we recover the economic benefits embodied within our equipment, the future economic benefits are going to be taxed, okay, via the inventory that we produce being taxed. So the question is, if we're going to be taxed in the future, what are the deductions that we can utilize against that tax? Okay, so what deductions can we utilize against the fact that I'm being taxed for the sale of my inventory? And the deductions that we can utilize, it's the wear and tear. Okay, so the wear and tear allowances that we get in the future, that's the deductions that we utilize. So then our tax base becomes our future deductions. So if you look at this line item over here, in year one, we've already had 2,500 as a deduction. Remember up there we had 2,500. So now, what are our future deductions? Our future deductions, it's the, we've had the 2,500 over here. Let me highlight this. Let's do it in that green over there. Okay, so if we have already claimed this wear and tear, what's the future deductions? It's 7,500. Okay, so therefore our tax base becomes 7,500. Now what about next year? Next year we will have claimed another 2,500 in deductions, right? What is our tax base? It's the future deductions, so it becomes 5,000. What about year 3? We get to claim another deduction. What's our future deductions? It's the 2,500 over there. And in year 4, we have claimed all our deductions. So in year 4, the tax base becomes 0 because we have no more future deductions. Okay, so that's important in terms of understanding a tax base. Now, before I take I go and look at the questions, I just want to finish off the idea of a tax base. Okay, we've said there's two things to consider. Are the FEBs taxable? Are they not taxable? Okay, so if the FEBs are not taxed, meaning when you recover this asset, you're not going to be subject to tax, then the tax base is just the carrying amount. So let's think of an asset to which this could apply. If you think of something like trade receivables, what does trade receivables represent? It represents the credit sales that your customers made. Okay, so you made sales on credit to them, and they promised to pay at a later date. Now, if they are going to pay you at a later stage, you have to ask yourself, are you going to be taxed? Well, we know from tax 1 that income is taxed at the earlier of receipt or accrual. So that means that when the credit sale was made, the sale accrued to us, so SARS already taxed us, which means that in the future, when our debtors or our trade receivables, when they actually settle with us, that amount that we get is not going to be taxed because it was already taxed when the sale happened, right? So the future economic benefits of my trade receivable, which is the cash that I'm receiving, is not taxed. And so because the future economic benefits are not taxed, the carrying amount becomes the tax base. Okay, so that's the important thing you need to consider with tax base. So I'm going to go back to the comments and see if there are any questions. Okay, so I've got a question here. Can you then just say tax base from SARS perspective is the carrying amount less wear and tear to date? Okay, well, it depends, because if it's, in this case, if it's the if it's the equipment, then yes, it basically is the carrying amount minus the deductions they've already given you, because they are looking at what is it's basically they're saying, well, what is the future benefit still, and it would be the future deductions that's still embodied there. Okay. However, if the FEBs are not taxable, then we can't say less wear and tear and so forth, because we don't have that, right? But if we think about it from your trade receivables, if SARS were to draw up your financial statements, what would they think your trade receivables is? Well, it would be the carrying amount, because there's no disputing what your customers owe you, right? If your trade receivables is 10,000, it means they owe you 10,000. So that would also appear on a SARS balance sheet, for example. So simplistically, we're saying that a tax base is what does SARS think the value of this asset is, but from an accounting perspective, we actually have a rule for how we're going to calculate a tax base for an asset and for liability. For an asset, it's future deductions if the future economic benefits are taxable. If the future economic benefits are not taxable, then it's carrying amount. Okay, I hope that answers. Okay, so when FEBs are taxable, it's like you have a recoupment. So basically, there is still future deductions, wear and tear allowances, benefits left. And if FEBs are not taxable, it's like when you have a scrapping allowance. Okay, so now I would tread carefully to try and understand it. To try and understand it that way, because the thing is that when you have recoupments and scrapping allowances, you will see later as we go through different examples, that's gonna have an impact on the tax, because on the tax base, because the tax base, remember, we're thinking about the future tax consequences effectively. So for now, let's just keep it simple and let's just say, if my FEBs are taxed, it must be what can I deduct against that amount that's being taxed, right? So for my equipment that's producing the inventory that I then sell and make a profit, those profits are going to be taxed. What can I utilize against those profits? It's the wear and tear allowances. Okay, and if my future economic benefits are not going to be taxed in the case of trade receivables, right? My tax base becomes just the carrying amount. Okay. Cool. Okay, I think that question maybe just continues, but I hope that helps. Okay. I think it's very important at the start of deferred tax that we just try and keep our understanding as simplistic as possible, okay? Because the problem is that deferred tax gets increasingly complicated, okay, as you go along. So what happens is, I find that you learn deferred tax, so your knowledge goes up, up, up. And then there's a point where you actually, it's almost like your knowledge is going down because you feel like, did I actually understand what just happened? And then there's another point where it actually starts to click and then your knowledge just goes back up again. Okay, so what I'm trying to do is I'm trying to keep it as simple as possible, because next week I'm gonna introduce a bit more complications, and I just want you to understand for this week. If you can understand this example, if you can understand what a tax base is, if you can understand the TAT that you're going to do next week, if you can understand those three things, then you're in a very good position for week 2 onwards. Okay, so I'm going to get back to the example now. Okay, so we spoke about a tax base. So now we must now compare this tax base to the carrying amount, right? And we're going to subtract the one from the other. So we subtract the carrying amount, okay, from the tax base. And there we're going to get a difference, right? Now this we call a temporary difference, okay, because this difference you can see is going to unwind, okay? The difference gets bigger and bigger and bigger and bigger, and then it will kind of reverse in the final, in the last year. So this is a temporary difference, okay? Now with this temporary differences can be either, they can be taxable or they can be deductible. Okay. Now what does it mean if a temporary difference is taxable? If a temporary difference is taxable, it means that in the future my tax profit is going to be higher than my accounting profit, right? So that means if my tax profit is higher than my accounting profit, then it means I expect to pay more tax. Okay. If it's deductible, then it means in the future my tax profit is less than my accounting profit. So that means that I expect then that I am going to pay less tax. Okay. Now I know that's a bit theoretical, but let's think of this example. What does it mean in this context? So if I look at the temporary difference that I've got over here, okay, my temporary difference of 500. Okay, what does this temporary difference represent? Okay, I've got to decide now, is this taxable or deductible? Okay, so let's think about it. Okay, so if I'm thinking about the future, let me write something here. Okay, so I'm thinking now in the future. So in the future, I want to think about my accounting profit, and I want to think about my tax profit. Okay. So in the future, right, what's going to happen to my accounting profit? In the future, so the future being after year 1, right? This area now that's grayed out, that's the future, because we're standing in year 1. So in the future, what's going to happen to my accounting profit? In the future, I'm going to have depreciation that totals 8,000, right? Because this asset is going to be fully depreciated. How can we see that? It's this over here, right? It's 8,000 in depreciation, which means that in the future my accounting profit is going to go down by 8,000. Okay. Now if I think about my tax, what's going to happen to my tax profit? So my tax profit in the future, I'm going to get deductions, okay, of 7,500, right? So in the future, my tax profit is going to go down by 7,500. So in the future, what's going to be higher? Is my accounting profit going to be higher, or is my tax profit going to be higher? Okay, well, let's think about it. I am taking more of an expense in the future. So if I have more of an expense in the future, then it means that my accounting profit will be lower and my tax profit will be higher. Okay? because I'm deducting more. So then my accounting profit is going to be lower because I'm taking more away, and my tax profit is going to be higher, okay, when I compare to my accounting profit. Okay, so these two, this consideration in the future, I'm always looking at accounting profit and tax profit, and I'm comparing the two. Okay, and yeah, I can clearly see that tax profit is going to be higher because in the future my deductions are going to be less. Okay, which means that I'll actually end up paying more tax in the future. So if my tax profit is higher, that then means that my temporary difference must be taxable. Okay, so this is a taxable temporary difference. Okay, it's a taxable temporary difference. Why? Because we are going to end up paying more tax in the future, because your tax profit in the future is going to be higher than your accounting profit because you're taking less of a deduction in the future. Okay, I'm just going to look at the comments to see what's going on there. Okay. This is from the test your knowledge from this week. Why does the tax expense in the income statement not represent the tax that must be paid to SARS? Okay, we're gonna Retabila, we're gonna talk about that when we get to the end of this example. So I'm just gonna park that for now. Okay, that will become clearer as we go along. Okay, so getting back to this temporary difference then is going to be taxable, okay, in the first year, and we can see that it's unwinding. So what does that mean? Okay, what does that mean from the statement of financial position? Okay, from a statement of financial position, okay, when we start, okay, at the beginning of the year, we have an opening balance for deferred tax, for our deferred tax liability of 0. Okay, there was no deferred tax. Okay, I just lost you. Am I back? Can somebody just tell me if I'm back? I think I just ended the stream on my side. Am I back? Please let me know in the comments. I don't know what happened there. Anyone in the comments? Okay, fantastic. Thank you. Okay. Okay, cool. So now we're starting with a deferred tax liability of 0. Okay, now this temporary difference, we have to provide for deferred tax on that temporary difference. Why? Because it's going to give rise to us paying more tax in the future. And because we're paying more tax in the future and we've recognized the future economic benefits today, we must account for the tax. How did we recognize the future economic benefits? By recognizing that carrying amount of that asset, we have recognized the fact that in the future we're actually going to get benefits of 8,000, right? But those benefits are going to be subjected to tax, so we have to account for the fact that there then is deferred tax, because deferred tax is recognizing the future tax consequences of all the assets and liabilities. And over here we see with this part over here, I'll just border that, okay? In the future, I'm actually going to end up paying more tax because of the way these differences are unwinding. So therefore, it's a taxable temporary difference. So then we're going to take the temporary difference and we're going to multiply it by the tax rate, and that's going to give us a deferred tax expense of 200. So we would have, if we think about the journal entry, we would then say deferred tax in profit or loss, it would be 200, and we would credit deferred tax in the statement of financial position 200. Okay, so deferred tax, when we credit it in the statement of financial position, it is a liability. Now you may be wondering, why is she using SFP? Why not just L for liability? Okay, because deferred tax can be an asset or it can be a liability. Okay, so just to save myself confusion, I just credit SFP one time so that I don't have to think about whether it ends up being a liability or not. So crediting statement of financial position means you're recognizing a liability. Okay, so then we're going to have a deferred tax closing balance then at the end in the statement of financial position of 200. Okay, then going forward next year, we're going to see that the temporary difference increases. Okay, so why does it increase? Because the difference is getting bigger. Okay, every year we're taking more of a deduction from a tax perspective, so the difference between accounting and tax is growing every year. So then we would have to go and account for deferred tax again on this movement in the temporary difference, because it went from 500 to 1000. So what's important to understand is that this liability over here, right, it carries over because it's a balance. So my starting point is that I have a liability for 200, right? But what must my liability be? It must be the temporary difference times the tax rate, which is 400. So I want my liability to be 400. So therefore, in the current year, I must recognize a movement of 200. So my journal entries effectively in between year 1 and year 4. Okay, so year 1 to year 4. I'm going to process this same journal entry over year 1 to year 4. The only difference is that the actual liability is going to be increasing, right? But the journal entry I'm processing is going to be exactly the same. Then come to year 5. Okay, so in year 5, the asset has been fully depreciated, so there's no carrying amount. The asset has been fully written off, there's no tax base, so there's no temporary difference. Okay, so if the asset now, it has disappeared from our statement of financial position, we currently are sitting with a deferred tax liability of 800, right? So this asset it's fully depreciated. We've now fully realized the benefits involved in this asset, so there's no more future tax consequences. Because remember, deferred tax is always looking at the future. In the future, there's no more tax consequences. This thing has been fully written off. Okay, so we expect there to be no more deferred tax. So if there's no more deferred tax, okay, so please explain that again, why it's taxable. Okay, so let's talk about why it's taxable. Okay, if I look at this amount over here, okay, these amounts, let me highlight that. I'm running out of like highlighting colors here, more colors. Let's go with like a lighter version. Yeah, there we go. Okay, so when we're trying to determine whether temporary difference is taxable or deductible, okay, we must think of what happens in the future. Okay, so in the future, what's going to happen? With my carrying amount, if I'm sitting in year 1 and I have a carrying amount of 8,000, what does that mean? It means in the future years, I'm going to actually have depreciation of 8,000. Okay, so my accounting profit, if I sum up my future years, is going to go down by 8,000. But my tax profit is going to go down in the future by 7,500, because this year I actually claimed a bigger deduction. So because in this year I claimed a deduction of 2,500, I actually ended up paying less tax than from an accounting perspective. Because from an accounting perspective, there was a depreciation of 2,000, whereas from a tax perspective there was a deduction of 2,500. So I ended up paying less tax because my deduction was bigger than my accounting depreciation. However, in the future that reverses, because then in the future I'm going to end up paying more tax. So because I'm taking less of a deduction in the future compared to my expense from an accounting perspective, I then expect to pay more tax. And so if I'm paying more tax, then my temporary difference is taxable. Okay, because I'm paying more tax. I hope that helps. Okay, then there's another question. So basically what you put on your statement of comprehensive income will be different to what's on your statement of financial position. Yes. Okay, so what goes on your statement of financial position? Okay, of course there would be the carrying amounts of your assets and liabilities, and then there would be this deferred tax liability. So this liability over here is sitting on your statement of financial position. However, what's sitting in your income statement is going to be different because your income statement, remember, is the movement. So the statement of financial position tells us the balances at a particular point in time, whereas the statement of comprehensive income, or our income statement at least, gives us the movement over a particular period. Okay, so the income statement is giving you the difference between what is happening last year in the statement of financial position and what is happening this year in the statement of financial position. So let's look at the income statement. Okay, let me just see if there's another question before I move on. No. Okay, so let's look at the income statement. Okay, so from the income statement perspective, what is my profit before tax? Okay, so my profit before tax is the 3,000 because I had that up there, right? So it's over here. So I just copied that line down over there. That's my profit before tax. Now again, this is different to the illustrative example because in the illustrative example there wasn't the business hadn't generated a profit. So this is different, okay? But I think it's better this way because I can just understand it better this way if there is numbers to deal with. Okay. Now that's profit before tax. Now what you're going to see next is your tax expense. This over here, right? This portion over here, that's not on the face of the income statement, but I'm including it in the face of the income statement because I want you to see what the tax expense comprises of. Okay, so you're never going to put current tax and deferred tax on the face of the income statement. You're going to put tax expense, right? But I want to show you what is sitting in tax expense. So in tax expense, we've got current tax and deferred tax. Now, current tax represents what tax did we pay to SARS, okay? So, current tax is paid to SARS. But deferred tax represents our future tax consequences, right? So, it's representing the effects of the tax consequences that we will face in the future because of the assets and liabilities that we've recognized today. Okay, we've recognized assets and liabilities today that give rise to tax in the future, so we're accounting for that tax now as well. Okay, so if I look then, my tax expense, and I know now it's current and it's deferred tax. So my current tax, I worked it out over here on top. Current tax at 40%. I just pull that line down and it goes over there. Okay. What is my deferred tax? My deferred tax is over here. Okay, because this is the amounts that was in the amounts that I worked out, the movement that went into my in my profit or loss. Remember, I was processing these journal entries every year and there was an amount, an expense that went to my income statement. So that movement over there gets added. Okay, so you can see that it's an expense in year 1 to 4 and in year 5 it becomes an income. Okay, so that means our tax expense now, if we add those two, is 1,200 every year. Now, if I didn't have deferred tax, okay, so let's just delete that. Look at what happens. If there's no deferred tax, then my tax expense every year, okay, is actually different. Now, does that make sense? Okay, because the business has the same profit before tax and they have the same, they've got the same underlying asset. So if the asset is the same every year, the benefits of the asset are being consumed the same every year, the profit is the same in every year, why is the net profit, right? Why is that so different? Why is the tax expense different? We would expect it to be the same. And that's what deferred tax ends up doing, okay? It basically aligns our tax profit to reflect what we expect it to be. right? So by having deferred tax, look at this, okay? The tax expense then becomes exactly the same every year because the asset is exactly the same, the profit is exactly the same. We expect the tax to be exactly the same. What's the other thing you notice? If I take my tax expense and I divide it by my profit before tax, okay? What's that? 40%. Okay, so it actually brings my tax expense, my effective tax expense, back to 40%, which is what I thought it would be. Okay, we were paying tax at 40%. If we took out deferred tax, okay, can you see that the tax, okay, why is the deferred tax not increasing? Okay, so why isn't it 400 in year 2? Okay, the deferred tax is increasing. Okay, but remember, in year 2, so last year in year 1, I recognized 200 and I got a deferred tax liability of 200. Right? So last year's closing balance becomes this year's opening balance. Okay, because now those things are the same. So in year 2, my opening balance is 200, right? And my closing balance, I want my closing balance to be 400, right? Because it's the temporary difference, the 1,000, times the 40%. So I want it to be 400, and the movement then is 200. So this movement over there, that is what happens in the income statement. But from the statement of financial position, in year 1, we have a liability of 200. In year 2, it's 400, 600, 800, and then 0 when the asset is gone. Okay. So it is actually 400. It's just important to remember that that profit or loss is giving us the movement between the two. Okay. Are there any other questions? Okay, so I don't see any other questions. Okay, so then just to let's just do a quick wrap up. Okay, so in terms of deferred tax, what is important? Okay, let's go back here to, here's another question from Candace. How do we know if the deferred tax amount is a liability or an asset? Is it linked to being taxable or deductible? Yes. Okay, so if it's taxable, okay, it means you're going to pay more tax. So if you're going to pay more tax, that's a liability. Okay, and if it's deductible, it means you're going to pay less tax, so that is a benefit for you, so that is then an asset. Now in the first semester, we're basically just going to be dealing with deferred tax liabilities, so that means that overall, when we sum all our temporary differences that are taxable and deductible, there will be a liability. In the second semester, we're going to look at deferred tax assets, because there's just an additional, like there's recognition issues around deferred tax asset that you don't need to worry about now, but you've exactly got the understanding there. Okay, so just to then sum up, to go back. Okay, so let's go back to the beginning of IAS12. Okay, it says, remember, the principal issue in IAS12 is that it is accounting for income taxes, okay, and we're trying to decide how to account for current and future tax consequences of the future recovery or settlement of the carrying amounts of our assets or liabilities that we've recognized. Meaning that the assets and liabilities sitting in the statement of financial position have future tax consequences, right? They have both current tax consequences and future tax consequences. And so we want to, today, in our financial statements, account for those future tax consequences. Because it's not correct to just recognize the fact that there's going to be future economic benefits, but not recognizing the fact that those future economic benefits are going to have an impact on our future tax as well. Okay, and then also we want to recognize the current and future tax consequences of transactions and other events in the current period that are recognized in the entity's financial statements. So that's what we're trying to do with IAS 12. We're trying to to reconcile current current tax and future tax for the assets and liabilities. So we're always looking at it from the perspective of the statement of financial position. So a little exercise that I think could be useful for you to do is go and draw up a little statement of financial position for yourself, okay, where you have so let's say you have your statement of financial position. So what would you expect? Okay, you would have the equipment under assets, and you would have a deferred tax liability. Ooh, liability. And for each of the years, go and plot in the amounts. Okay, so what must be the carrying amount of the equipment, and what must be the carrying amount of the liability. Okay, and over here, I've already done the income statement for you, so you don't need to go and do that. But go and do this for yourself so that you can see what it is going to be. And yeah, I'm gonna post this spreadsheet as is on Vula afterwards. Let me just think if there was anything else I wanted to say before we end the stream. So the only thing I cannot stress enough is reading paragraph 7 and 8, and below paragraph 7 and 8 there are examples on tax base, so make sure that you do read that and you really grapple with those things. Deferred tax, like I said, this is not easy stuff. But if it was easy stuff, then you wouldn't be wanting to do it, because you want to be a chartered accountant one day and you want to earn mega bucks one day. And so you can't earn mega bucks by doing easy stuff. Okay, you've got to do some difficult stuff. And I think if we look on the positive side here, right, this is challenging, but think about it. Every year since you started preschool, right, you've been dealing with challenges, right? So your first challenge was learning the sounds of the alphabet, right? Now you know ABC, but you used to call it a, b, k, and you know, those sorts of things. So you started there. Then a challenge was to learn how to spell cat, k, at, cat, okay? Then your next challenge was to learn numbers, you know, what it actually meant to count. Then you got to high school. Then you were doing maybe calculus or whatever the case may be. So every year there's challenges, and look at deferred tax as just a new challenge. It's just a challenge that's standing in the way of you now getting your degree. But since you were in preschool, you've been rising to the challenge. So this is just another opportunity for you to show how awesome you are, in that you can actually, you know, rise to the challenge. So take this challenge head on. Okay, read when I tell you to read. I beg you, please read when I tell you to read. I'm going to try and do more of these live streams. If it's something you're interested in, just let me know. And then, we can kind of take it from there. I hope this session then was useful to you. And just give me, you can also maybe send me some like an email if you have an idea of something you want me to discuss. And I think what I can do is I can schedule live streams and I can just talk about the things that you want me to discuss. And if you can't make it for the times that I'm available, then you can always watch the recording at some point, because for me the times I would be available would be like in the evening after my kids have gone to sleep. So like I could then totally sit on live stream, like, you know, after 8 o'clock and just talk about accounting. But if you can join when those things do happen, then please do. Maybe also subscribe, because then when I go live you can just get notifications and stuff like that. Cool. So thank you very much for your time, and I will see you in the next live stream. Go forth, conquer, be great, do your knowledge checks, do your objective test, do that TAT, attempt that TAT as best as you can, and next week your tutor's just going to come in there and give you like another level of knowledge. But I'm telling you now, if you want to upstage the tutor next week, you read paragraph 7 and 8. Okay, you understand what a tax base is, and hint, there's paragraph 15 in there as well. So look out for that paragraph 15. Okay, cool. So I'll see you next time. Okay, bye-bye everyone.